Are you wondering how to start investing like the best investors in the world? Warren Buffett, Guy Spear, Monish Pabrai. You've come to the right place because you're listening to Investing Mastermind Podcast. My name is Signe Lonholdt.
And I'm Michelle Marki.
And today we're gonna dive into how does these super investors invest? What is one of the strategies that they are using that we as private investors pretty easily can also adapt and use in our daily lives? That's what we want to discuss today, because last time we did mention that we wanted to dive into this topic. And so today we're gonna unpack a few of the things that is in Warren Buffett's strategy, and then we might actually take some deeper dives into some of the specific topics later on in the podcast. But Michelle, Warren Buffett's strategy, can you sum it up for us, like real quick? What are some of the components when using Warren Buffett's strategy? What is it, something we want to look into when we actually want to apply his strategy for ourselves?
Yeah, I think Charlie Munger, the longtime business partner and closest friend of Warren Buffett, said it best when he said, buy wonderful companies at a fair price. That is the essence of Warren Buffett's investment principle.
It's like buying quality at a sale, right? So, you go find a nice sweater that is great quality. You wanted it for a while and now you can get it on sale. This is also Warren Buffett's strategy when it comes to stocks. And it's actually deviating a little bit from the value investment strategy that Ben Graham introduced because, like you said, Charlie Munger, who was business partner and friend of Warren Buffett, he actually was the architect behind the strategy that Warren Buffett is using today. So the strategy that Warren Buffett got from his mentor, from his professor at Columbia, actually is different than the strategy he's using today. And that's, the strategy that Charlie Munger and Warren Buffett applied. That's the one we're talking about. We're not talking about the, Benjamin Graham type value investing on this podcast. It's a little bit different. So
Yeah. And the essence of Ben Graham's style is to buy fair companies at wonderful prices. So, kind of the opposite of what Charlie Munger said. So, what Buffett and Ben Graham used to do is just buy a ton of companies at rock bottom prices, knowing that they might be liquidated or go out of business. And they would try to get the last cigar puff out of them. So then they would move on and buy other companies. But that is very different from what Charlie Munger instilled in Warren Buffett to only buy a few companies that you've studied and you have this belief in the company for the future and what the criteria is that we're about to talk about today. That's what we should base our investments on, is like more of the Charlie Munger style.
yeah, exactly. So where you could say, the value investing, as long as it's cheap, you grab it. So going shopping on a sale for cheap stuff in a dollar store or similar, get some cheap stuff. It doesn't matter. They don't look into what's quality and what is not. As long as it is cheap, go buy it, right? So okay, so when it comes to a stock, we could dive into actually, the first topic, like what is quality in a stock, because when you go to a store, it might be easy to see, okay, this is a great quality leather purse versus this plastic purse that looks like leather, but it's not really leather. So maybe the quality of the leather, you can see that that's better than the plastic one, which you can see, okay, it's going to crack the minute I start using this wallet. But in the stock market, what's one of the things that you look into, Michelle, to actually determine whether or not a stock is quality or not?
One of the markers of quality is if the customers of this product or service keep coming back to using it. So, an example of quality is subjective, but it could be in the everyday products we know and trust. Like, for example, businesses are mainly using Microsoft in a lot of their everyday business operations, and Microsoft products have a staying power, which suggests it has quality because the customers keep coming back to using it. They renew the licenses every year. Whereas we don't use some other maybe early computing competitors that may have been out there. And that could be an indication of the Microsoft stock's staying power. Just as an example, maybe people don't think Microsoft is a quality company, but that's up to each of us to decide.
You could say, actually, an example of a business that wasn't able to keep competitors were the German company SAP, which at some point became so difficult for users to actually use. It became this system that was so difficult to use that customers started to abandon the program and actually started to use other programs instead of SAP because we needed an army of other people to actually be able to use the system. And that made customers go away. So how can people actually find out whether a business is, where customers continue to buy or not?
Yeah, and that's where you have to look at something called your circle of competence, like what you understand and can know about a company to know if it has quality and staying power. And when we think about circle of competence, this means the areas that you are capable of understanding. Like, for example, if you like makeup, you are probably capable of understanding which products in the makeup space are really good, like which are good quality makeup products that you use and you trust and it doesn't make your skin break out in a rash. That's something that you can know and understand, right, Sina?
Yeah, I'm sitting here smiling because I love makeup and also the thing about makeup is that when I need to buy some new makeup, I prefer to go to the store, to an actual physical store and try it on. Like, how does it feel on my skin? Test it out. Like you say, is my skin gonna break out? So I might do a skin test on it before I buy it. So I wouldn't, if I needed something new, which I occasionally do, I need some new makeup and I'd like to try something new. There's maybe been innovation or things like that. Then I go to the store. I don't order it online and then try it on only to find out, okay, this was not my color or this was not good for my skin. So something unique about that type of business is actually that a lot of people prefer to go to the store to see, okay, how is the color on my skin? How does it blend in and things like that. And you can't do that, at least today, when you order it online because you get this, actual piece and then you open it and then too late. So as it is today, you need to go to the store.
How is it that you developed the circle of competence around makeup?
First of all, it came because I'm in generally interested in makeup, buying it and using it. I really love that. But then the next thing was, then I started actually studying the different kind of businesses. So it could be makeup companies or it could be, stores that sell makeup and things like that I actually became quite passionate about finding out what's unique about this type of business. So, for example, a production company that produces makeup is pretty simple to understand. They need to sell more makeup and then they need to keep their expenses low. So, when you look at the bottom line, they need to prove that they've sold more makeup and kept their expenses low to actually see, okay, they came out with a profit. And a way you can easily see did they come out with a profit when it's a production company is looking at the EPS. It's a measure that you can find for example, if you have an iPhone, there's a stocks app that comes with the iPhone, or many websites show the EPS. If the EPS is in minus, it means that for the past 12 months, they sold less than they had of expenses. And if the EPS is positive, then you can say, okay, at least it's not a terrible company. Like if the EPS is in minus, it's like, okay, no, thank you. So that's just a quick thing that you can go check easily in your app. It's right there. It's very easy to find. It takes 2 seconds and you can pause the podcast and actually open, for example, the stocks app on your iPhone, look for a company and then look for their EPS in the stocks app and boom, you have it. Is it minus? It's sickly. If it's plus, you can continue to look into that business and look more into it. But that's just a quick thing you can do.
Yeah, and even if earnings per share, this EPS could be negative for now, that could be a signal that maybe the company's just going through an event. And that's a topic for another time. But basically maybe there's some temporary issue that's making the company earn less right now. So it might seem negative for a temporary time, but it doesn't mean that the company is dying. So you have to assess if the company can get out of this funk or if this is going to spell bad news for its future and you should run away quickly. Like there have been other companies that have recently filed for bankruptcy and probably their earnings per share went down drastically. So you have to like decide if this is temporary or a terminal problem with the company.
Yeah, and I think for beginners, it's a good idea to just start with, the easy thing that is, positive because as you get more advanced, then you can start maybe, you know, looking into, okay, how long term is this going to take? But as a like total beginner, it's a good idea to maybe say, okay, I'm going to pause this. I'm interested in this company. I could put it on my wish list and maybe look into it a little bit later. But if you're a more advanced investor, yeah, 100% you can go in and take a look at, okay, how long is this going to take? What's something that you would potentially look into, that you can maybe advise people to go look at when you look at quality companies?
Also, a good quality company is if you notice that they're able to grow based on before, that they're not just somewhat stuck in just barely kind of moving along over time. So, for example, there are some companies that generally will have a lower growth rate and they may have fully matured, and that's kind of just where they're at. They're not going to innovate that much more. They're not going to generate new products and services that excite people. So sometimes quality is shown in a company's ability to innovate and grow. And the more that a company can wow its customers with innovation and making things even better than before, companies like Apple, for example, I'm not saying that it's necessarily the best quality company, but some people like Warren Buffett have said in the past that Apple was the best company. So we can learn a lot from Apple's example, and we could try to determine if they are still a high quality company or if they're starting to do things that show that they're running out of innovation ideas and they're not growing as much as they had once in the past. So you could see that compared to other fully matured companies, say a lot of consumer packaged goods companies, like those who sell toothpaste and soap, they're not really growing and innovating that much. Like their products that you use every day are not really changing. Like I don't think toothpaste has really changed in decades. So you can see that there's only a limited runway for some of these consumer packaged goods companies, but with the advent of AI, maybe some tech stocks might have the ability to keep innovating and offering more quality value, like in terms of the products and services that we benefit from. That could be an indication of quality if people are able to offer valuable, innovative products.
Just like humans go through different life stages, companies go through different life stages. So from infancy to toddler to teenage years, and then young adult, and then, maybe slowing down a little bit throughout the end of the life cycle. And it's something you can also determine where is this company in their life cycle. And even what's different from companies to humans is that they can actually sometimes go back in time and start their teenage years again. And that's very much up to management. So sometimes a new manager comes in and totally revamps the business and that's what management can do. They can kind of start differently in that life cycle and maybe take the company back and, yeah, innovate. Or what we also see sometimes is companies that, just adapt to time. So, for example, right now, where we've just kind of come out or are coming out of high inflation, what we've seen is that some companies, this minute the inflation increased, they went back to some other types of business models. Like, for example, some companies would stop innovating and just bring people what they wanted to, for example, drink. So they had all these when there was a lot of growth in the world, you could buy any kind of drink with all kinds of different flavors and just take down from the shelves. Now we see a period with inflation, and then that company says, okay, we're going to stop innovating like the cactus flavor and just bring people what we know they'll take down from the shelves, like the original and maybe without sugar and maybe, a few of the other best sellers, and then just not bring new things into the market because people also, when people don't have a lot of money, which usually happens with high inflation, they don't spend as much money. They tend to actually take down the products that they know. So that original drink that they knew, they're going to take that one instead of trying something brand new that they're not guaranteed it's going to be quality, that they're going to like the flavor. They don't want to waste money on something like that. And we just saw a bunch of companies that did exactly that. But I also noticed that there was actually some of the, companies that's existed for many, many years that said, oh, we're going to innovate our way out of the crisis, where I thought, I don't know if that's the best way of getting out of this crisis because, it was Nike in particular. And Nike have a ton of sneakers, for example, that are like bestsellers, and they could find out what are some of the bestsellers in previous years where there was high inflation, and maybe we should bring that back. But instead, they actually said they wanted to innovate their way out of the crisis, but then they changed CEO after. So maybe it's different now, but that surprised me because that's not what most companies does and the learnings from most companies. So it's just we also talked about last time, what's something that's different right now. And it's definitely, companies that can come out of a crisis. That's what the companies we want to look into. So we want to see the companies that can navigate the way out through crisis so that, they, for example, have high margins. That means that they don't have a whole lot of expenses. So, when you look at the product, you can see, okay, they can sell this product for $20, but in reality, it only cost a few bucks to produce it. That's the kind of company that would do good right now.
So, in today's episode, you heard us talk about the full range of Warren Buffett's investment principles, and we touched on several of the areas that are key to this strategy, including circle of competence, the management of a company, the margin of safety, and also the moat, which is how a company has staying power. So, we'll dive more into some of these key areas in future episodes, but you heard us reflect when you are studying a company, you want to assess a company from all of these perspectives of how a company measures up to Warren Buffett's criteria. So that was a little bit of a nutshell of what you can expect if you were to adopt this sort of Warren Buffett style investment strategy. And it's definitely been very helpful to Signe and me, and I hope that it would be helpful to all of you out there as well.
Yeah, and if today was, where you thought, oh my goodness, this sounds kind of complicated, well, listen to the next couple of episodes because we're going to take it from the ground up and really going to introduce you to some of these different topics here. So this was a bit of a taste of what you can expect, and then we'll, start slowly and introduce you to each of these different kind of areas in Warren Buffett and Charlie Munger's strategy over the next couple of episodes. So this was it for today, and we'll be back in 2 weeks from now.
Till next time.
If you enjoyed the show and found the content informational, we would be super grateful if you would leave us a review and follow us wherever you get your podcasts so you automatically get new episodes in your feed.
The contents of the Investing Mastermind podcast are for educational, informational, and entertainment purposes only. None of this is investing advice, and if you need help in your personal situation, please consult with a professional.